All right, so last section for the income statement, we're going to be talking about profitability analysis. If you remember from the balance sheet, we had kind of talked about 4 ratios. Now we're going to introduce, I think, 6 more, kind of group them and kind of get you to try to understand how to use the income statement to do some more analysis. And if you remember, there were kind of 4 types of analysis that we did. We had the vertical analysis, horizontal analysis, comparative financial statements, and then ratio analysis. And of course, this falls into that last category of ratio analysis, trying to understand and get better measures of performance so we can kind of compare, different companies. And so the first set of ratios we're going to look at are called activity ratios. And so also known as turnover ratios. And so the whole idea with an activity ratio is, is a company managing and utilizing their resources to produce a profit? I mean, that's kind of the whole idea is, are they efficiently utilizing those resources? And so, we talk about, what category of ratios help them evaluate this. Again, the title probably gives it away, but the primary way that you kind of measure, are they effectively using their resources, is activity or turnover ratios. And so, again, whether it's a particular type of asset or assets in general, these turnover ratios measure the amount of assets that are needed in order to maintain or sort of reach a level of activity. And so usually that activity is going to be revenue. You're going to see in at least one case it's not revenue, but it's related to it. So so turnover ratios are the general category that they use to describe these types of ratios. And so the 3 most common ones: asset turnover ratio, receivables turnover ratio, and inventory. And so obviously asset turnover is going to talk about, the efficient use of all of our assets. The receivable turnover ratio is the efficient use of receivables. And then finally, inventory is the efficient use of inventory. Again, so that's the general idea. And so looking at this, you can see we have, total amounts and also an average. And so the interesting thing when you talk about turnover ratios is you have a balance sheet item, either receivables, inventory, or total assets, and you have it connected to an income statement item, either net sales or cost of goods sold, at least for these 3. And so what you have is you have an income measure over a period of time, but you have balance sheet items that are measured at a point in time. And so for that reason, when we talk about intermingling income statement items and balance sheet items, most of the time you're going to use an average. And the whole idea of an average is the beginning balance is maybe not quite indicative of what's going on overall, and the ending balance may not be quite indicative. And so the average kind of at least gets you somewhere in between the 2. And so it's not perfect, but that is generally what we're going to use. And you're going to see that play out as we start calculating the ratios here. And so for the asset turnover ratio, I mean, the calculation is net sales over average total assets. Again, notice when I highlight here, we are using average total assets. Again, it's how efficiently are we utilizing its assets to generate revenue. And so, the higher the number, the more efficiently we're using those assets. Again, in this case, higher ratio kind of implies more effective use of a company's assets. And so I will say, in general, higher is quote unquote better in this case, because you want to be more effective. The only thing I'll do is I will say there's a caveat here. And the caveat would be is if this ratio is being driven by the liquidation of assets, where it's sort of going to be long-term, not sustainable, that would be a problem. But if I can generate the same number of sales, but have fewer assets doing it, I mean, that's a good thing. But again, it's just a little bit of a caveat, but a higher ratio implies more effective use of company assets. And almost in every case, I cannot think of a situation where it would not be true. That is better. So I would say, higher asset turnover is more efficient. It's a better situation for the company. So what is 49er company's asset turnover based on the previous slide? We had a revenue of 146,800, and we had total assets of 500, or average total assets 542,500, which is 0.27. So essentially, we need, for every dollar in assets, we are able to generate 27 cents in sales. And as far as whether that's good or bad, that's really very much industry dependent. So each industry is going to have its own ratio, sort of a normal ratio. The one thing we can say is 0.27 is more efficient than 0.2, and it's less efficient than 0.4. And all things equal, you prefer 0.4 over 0.27 or 0.2. So again, it's a little more straightforward than some of our other ratios where, like a current ratio, it could be too high and that could be a problem. And in this case, it's really absent some strange things going on, higher is going to be preferred. All right, again, just reminding us of the information that we have. In this case, we're talking about receivables, so we do know that we're going to be really focused on our net receivables, and we will also be looking at net sales. And so this is going to be our focus. And again, we focus on the average. And so thinking about those two. So as we move forward with the receivables turnover, again, it's net sales over average accounts receivable, similar to the total asset turnover. The higher ratio means that it's more efficient. And so if you have a higher receivables turnover, it means that you're more efficient at collecting cash. Essentially, you don't have as many outstanding receivables in order to generate the same level of sales. I mean, it would be great as a company if I could sell $1 million worth of product and have no receivables. But most of the time that doesn't happen. Most of the time you need to carry some receivables in order to get enough sales. So customers prefer to have the opportunity for some credit or a delayed payment. And so those receivables usually are necessary. But of course, you want to manage them down as low as you can in order to ensure you're generating those sales efficiently. Again, the ratio shows the number of times during a period that the average accounts receivable balance is collected. If it were like 10, that means basically your receivables are collected faster than once a month, or 10 times a year. So a little bit slower than once a month. If it gets above 12, it means you're turning it over a little faster than once a month, and on we would go. And again, the higher the ratio indicates you're more efficient. And so for 49er company, their ratio, again, we highlighted those two numbers. Their ratio is 13.35. So they're able to turn their receivables a little bit faster than once a month. A little bit faster than once a month. All right, so the next one's going to be inventory. And so again, we're looking at average inventory. But with inventory, instead of net sales, we focus on cost of goods sold, because hopefully you understand that these two things are connected. Right. So whenever we have a sale, we typically are going to be crediting inventory and debiting cost of goods sold. So these two really are very much connected, which is why we use them in the ratio. And so for inventory turnover, the numerator is cost of goods sold, the denominator is average inventory. And again, it's how many times is your inventory sold during a reporting period. And so again, a higher number means that you're able to turn your inventory more frequently, which means that you don't have to invest as much to keep generating sales. And so again, managing inventory is important. However, if you manage it too low, you could have what are called stockouts. And if you have stockouts, you're missing out on sales. And so, generally, again, higher is going to be better. It's preferred, but there's always got to be that caveat. So for 49er company, as we mentioned, their inventory turnover is 3.07. So they basically turn over their inventory about 3 times a year. Okay. So now we're going to be turning our attention to profitability ratios. And so with our profitability ratios, we're going to sort of I think we're going to cover 3 more. Yeah, 3 more profitability ratios. And so again, profitability is like, are you able to generate a return? Again, it's either return relative to something. So most of the time it's going to be, relative to sales or some sort of measure of resources. And so we're going to kind of cover both of those. But again, your whole idea is, are you able to efficiently generate return your bottom line income based on some level of sales or some level of resources? And it gives you an idea of, if we grow to the company, how much more is going to go to the bottom line. Resources, most often are going to be defined as total assets or total equity. It's very common. And then our 3 measures, profit margin on sales, return on assets, return on equity. Those are the three most common measures. And so those are the ones that we're going to use for this class as well. Again, profitability ratios focus on, can we provide a return for some level of sales and or resources? Again, so we're going to be talking about sales a lot as one piece of it. Income is going to be important. We talked about equity, and so we're going to be thinking about average equity, and we talked about assets. So depending on the measure, these are kind of the numbers that are going to be important to us. All right, so we're going to start with our profit margin on sales. And so that is net income over net sales. So in other words, how much profit or how much do I earn or how much return do I get for every dollar of sales? And of course, we know net income is always going to be less than net sales. But again, it's going to give us an idea of what's left over and, sort of what our, our net is at the bottom of the day, at the end of the day. So for 49er company, we know that net income is 23,814. The net sales was 146,800, which is 0.16. So for every dollar in sales, they net 16 cents. Again, generally higher is going to be better. I cannot think of a situation where you wouldn't like more as far as your net. But as far as whether this is good for this company, it is a little more ambiguous because you need to compare it to peers or industry average or something like that. The next measure is going to be return on assets. So again, in this case, we're going to be focused on these two numbers. So our average total assets and our net income. So again, how much profit are we generating from the resources, in this case, assets of the company? And so, net income over average total assets is our measure. Again, it's income as a percentage of the average total assets available to generate that income. Higher measure basically means that we are better able to produce income from those assets. Now, I will say the one benefit of using assets is it's agnostic about the way the assets are financed, because you can finance with debt or you can finance with equity. And so ROA is kind of a nice measure because it's devoid of the way that it's financed. And so rather than worried about are you fueling your assets through debt or through equity, this just kind of takes a agnostic view of that. And so for 49er company, their ROA is 0.04. So for every dollar in total assets, they're able to generate 4 cents of income. And again, higher is better. We prefer higher rather than lower as far as whether that's good for this company. Too many factors for us to conclude that right off the bat. All right, so now we kind of want to take a little bit more of a peek into this idea of ROA, and we're going to kind of do this a little more thoroughly with ROE, which is return on equity, here in a minute. But what we kind of need to think about is ROA really is a function of two things. If we kind of take return on assets, that's net income over average total assets, and if we multiply that by 1, all right. So net sales over net sales is just 1. So there's nothing weird going on. If we multiply that by 1, we haven't changed our measure, but now we have some sort of things we can do to rearrange these terms. And so if we rearrange them, we bring this over and kind of move some things around. We really have now two things: net income over net sales, which you've seen before, and net sales over average total assets, also something you have seen before. These are two ratios that we've already seen. And so this ratio is our profit margin on sales. And the other ratio, our ratio over here, is our total asset turnover. So what we have is really a measure of profitability over here. If I could make a good P, we have profitability over here, and we have efficiency over here. If I can make it better. Oh, fun. And so now it's basically what's driving our ROA. Is it our profitability or is it our efficiency? And so by disaggregating it into its components, we get better insight. And, again, not to belabor this, and I can see that it's not clear, but we know that our profit margin on sales was 16%, and we know that our asset turnover was 0.27. And so when we combine those, we get our ROA. But now we can see, sort of what is contributing. And especially if we compare one firm to another, and let's say one has a higher ROA. Well, is it that they're more efficient? Is it that they're more profitable? Or is it both? And so disaggregating it into its components is an important step to do when thinking about ROA. All right, last one, we're going to be talking about return on equity. So we are focused on ROE, which is down here, and of course our net income measure as well. And so again, the ROA was agnostic about the way that things were financed, but with return on equity, we are focused really on how much bang for the buck are we getting in terms of equity financing. So are they using shareholders' equity to generate returns? And so net income is in the numerator, average shareholders' equity is in the denominator. And then for 49er Company, when we measure that, we get 0.06. And again, for every dollar investment by our shareholders, we produce 6 cents of income. Again, we don't know whether they're good or bad. We can say on average, you'd prefer more. So the higher is generally better. But we're going to kind of talk a little bit more about that here in a minute, how there are certain levers that drive ROE that I would say cause a little more concern than something like ROA. And you're going to see that here in a minute. But again, generally speaking, if you can have a higher ROE, that's going to be preferred by shareholders. All right, so let's talk about ROE a little more. So return on equity really is a function of three things. So with ROA, it was a function of profitability and activity. With ROE, it's the same function, profitability and activity, but also now financial leverage. And this really is the piece that I want us to kind of understand a little more clearly. Is essentially what ends up happening is if you can increase your financial leverage, you can increase your ROE. So leverage in this case can be a good thing, but we do need to be a little bit careful, because if you're over leveraged, then your ROE may be high, but you may be in a dangerous situation. But let's kind of go through that same process where basically we have our measure of ROE here. Right here's ROE, and then we're just multiplying it by 1, right? So we have two terms that mean that both equal 1. So nothing's really going on here, but if we rearrange some things, now we see again our profit margin on sales. Now I have our total asset turnover, and we have this financial leverage term at the end, which is really called the equity multiplier. And it really gives you the mixture of assets to equity. So, essentially the higher this ratio, the more leveraged the company is, because it means there's more assets relative to equity, which means there must be more debt. And so when we look at this, it's sort of like any one of these can increase ROE. It's the question of which one. Is it that you're more profitable? Is it that you are more efficient? Or is it that you're more leveraged? Or is it a combination? Is it all three? What is it? I would say this DuPont framework is probably one of the more powerful ways that we can examine profitability in all of accounting. And so understanding these three pieces is really important to really understanding ratio analysis, because it brings all three pieces that drive profits into focus, which is just our ability to produce profits on our sales, our ability to be efficient with our assets, and our use of financial leverage. And so again, in this case, we know the number, but you can see that the three components, profit margin on sales, asset turnover, and now this is the equity multiplier, 1.38. So again, we have $1 on assets. For every dollar in shareholders' equity, we have $1.38 in assets. And so again, in this case, it's given us a picture that, obviously if we want to be more leveraged, it would go up. Let's say we had $2 in assets for every dollar in shareholders' equity, which would be about a 50-50 mix between, liability and equity. If we kind of rose that up and we could maintain the other two, we could increase our ROE. We could essentially, whatever that would end up being, go up to 2. It's going to increase it quite a bit, 70%. So all that to say, again, leverage can be useful, and this is a great way to depict that. But again, that brings us to the conclusion for the income statement. I do think, DuPont Framework is something that, whether you're doing accounting or finance, I think thinking about that going forward is really important in making good decisions and thinking about how these different levers can affect profitability. All right, that's all I got. We will pick it up with some problems in class or some review questions, things like that. But as far as the online lecture, that concludes it. Thanks.